getting a lot of questions about how do venture capital funds actually make their money. On the surface, it sounds very simple. They invest in a company, and then if that company has a big hit and it's worth a lot more, they take the difference, just like any sort of investment. But almost all venture capital funds are not the money being invested. Most of it, the vast majority of it, is often not the venture capital firm's partners' money. It's money of investors, say like someone that wants to invest in a VC fund or a startup fund. So how do these firms actually then make their money as well as benefit the investors? And a lot of people have been jumping into investing in startups and venture capital funds because it's trendy, it's hot, it's exciting, it's glamorous. They've heard the investment manager, the general partner, the VC fund, hey, we just had a big exit. Oh, I got to get involved. There's that FOMO aspect of things. And these things are all real. But it doesn't take away the need to do the diligence on, hey, guys, I'm going to give you my money. I understand you're going to invest it in these types of startups. Hey, I even understand there's a big risk involved that we may not even find a winner. And we can go into that a lot more later. But how much am I getting back on this thing here? What are we kind of looking at? Where's this going? And a lot of people don't really know. They don't really understand how these things work. So this will merit many different conversations about different fund structures and fee structures of venture capital funds that are there so you can understand what is it that I'm going to be paying these guys to do the work. There is almost always a management fee of sorts. So whatever amount of money you give to them, they're taking a percentage of it right off the top. And that goes into their own bank accounts to then, pay salaries, operating costs, the cost of kind of doing the research and diligence on your behalf to find the right companies. The other piece of it is the performance fee, the carry, which is the percentage of the gain that the VC fund keeps based on, how much the investment was initially compared to how much they took out from it. And it's typically also expressed as a percentage. A very common model, which is actually becoming much, much less common, and more on that in a brief moment, is 2% and 20%, where they're going to take 2% of your assets that you've given them, and they're going to kind of withhold that and put that in their own bank account to kind of pay some bills. In some cases, that 2% might be higher based on the type of fund, and they might say, look, we're going to need to take a lot more upfront in our bank account because, geez, we don't have anything yet. We got to pay some bills. We can't have our people starving to death. So, we understand that, but that's going to cut into the returns. The other aspect then is that performance fee. That 20% is a very common thing, 2 and 20. And even that is not as black and white. If you have one investment and they say, look, we're just going to take 20% of gains. You invested $100,000. Now we're at, and we sold it for $1 million. It'd be pretty rare, but it could happen. So there's $900,000 of gain. So you're going to pay us 20%, $180,000 on that gain, and then you're going to keep the rest. We're going to return the rest to you. So it might be a pretty big return when you think about it. But it's important to kind of understand these things. One, because they're investing the money across multiple companies, many with pretty high failure rates, right? It's like baseball. You could be batting 300 and you're an all-star, right? Most VC funds aren't going to get most of their deals right. In fact, they're going to get most of them dead wrong, meaning either a zero, it's going to go out of business, or the money is just going to be zombie money. It's going to be tied up in this company with no way to ever get it out. And then you have to look at the different fee structures. And again, the 2 and 20 is kind of going away, to the point where I saw a post the other day from a gentleman that advises VC funds about different fund structures and fee structures they should give to their limited partners. And he was very clear. He goes, based on the structure, here are 3 or 4 different scenarios. This one is going to yield the fund this. This one's going to yield the fund that. And, don't you as the VC fund want the one that's going to bring the most back to the venture capital partners, not the investors? And I think it's fair. Everyone should, have a chance to make some money and figure out the best fee structure for them. But it is important to kind of understand that you're not just kind of giving this money, and if they have a 10x return, you're not getting 10x back. You're going to get a lot less than that because you're going to have some losing investments. Some of these fees are going to be taken out upfront. Meaning, hey, we took your 100,000 to invest, but we really only invested 90,000 of it because we kept the other 10 for ourselves to pay some bills. And then, by the way, we're going to take a cut of that gain. So, you might think you might have been getting, oh, geez, I gave you 100,000. We sold it for $1 million. Great. Give me my $900,000. Well, actually, we invested 90,000. It went to, went to 900,000, 10x. And of that, we're going to be taking, 20% difference of that. So here's really 750 or so. It's coming back your way. Well, yeah, I thought I was getting $1 million. Well, I was getting 750. Hey, not a bad deal by any means, right? From going from 100,000 to 750,000 roughly, right? But could have been done better elsewhere. Maybe not. So one example of that, just it's important to understand the different fee structures, and there'll be a lot more on those here in future sessions.